We can see the risk, but if it's not priced in the market, then something, ugly could happen.
Yeah, I mean, I think that's exactly right. And the IMF said, investors seem to be underpricing risk. And how often have we said that over the course of the last 5 years? At some point, they'll turn out to be right. I mean, it is a stop clock syndrome in a sense, but equally, stop clocks are often right, at least twice a day. So, I mean, I think we could get to the point where, investors start to take fright when they see things like the Federal Reserve raising rates above the equilibrium level, wherever that may be, let's say 3%. If the trade war were to intensify, investors, have a lot to think about, and I just don't think at the moment they are.
Okay, Peter, let me go over to my, my chart of the day, which is basically you see some of the rate-sensitive sectors breaking out of the traditional relationship with Treasury yields, and then we saw that huge move in Treasuries, earlier in the week. What does that tell you about the markets?
Well, I think it tells you that markets, at least the Treasury market, is beginning to wake up to the idea that the Federal Reserve is serious about its monetary tightening process. About time too, you may say. But I still don't think it's percolating through the rest of the financial market space. I mean, I think equities still have potential for correction. I mean, I think they're being supported by these ultra-low interest rates. The valuations are being supported by ultra-low interest rates, and I think that over time, as markets start to factor in these higher rates, we will see equities soften. Whether or not that turns into a rout, let's hope not. But I certainly think that we are in need of a pause.